Good morning, everyone. It is 6 a.m. on Wednesday, July 24th, about half an hour before the market is going to open. And today I was up a little bit earlier than normal, and I have already been looking at the markets, and they are down quite a bit. The futures are down quite a bit. It's looking kind of ugly on first glance, but we're going to take a look very carefully and just make sure that we're not jumping to conclusions and that we are actually viewing through a rational lens and that we're getting the right perspective. So S&P futures down almost 1%. NASDAQ futures down 1.5%, and the Dow down about 45 to 50 basis points, so 0.5%. So that is definitely non-random. Dow is definitely not down nearly as much as the other two, but we are certainly not in random territory. We are definitively down even in the Dow. So obviously this is NASDAQ led, and we're really just looking at large cap or technology stocks. So we want to dissect this very carefully. And before we just get too excited about this being down, we want to make sure that we still have the proper perspective, and we need to see if we need to change our viewpoint. So far, from earlier this week, we were looking at a neutral portfolio and a large range chop sideways we identified as between 550 and 560 on the S&P 500. So let's take a look and see if we still have that opinion or this morning's data is going to change it. So in the pre-market, we're at 548.70 on the S&P 500. That's below that 550 area, the 550 to 560 area we've been talking about, but not hugely below. You can see that this orange dotted line, I don't know if you can see that super clearly on the screen, but there's an orange dotted line right here at 548.69. And it is inside of this bar right here. So since it's not below that bar, I'm not going to get too excited. And we were also talking about this 545 and 540 level from Monday. So we're still within range. There is every chance that today, during the market, we float upwards and we re-enter that 550 to 560 range. Even if we don't, if we say, okay, well, fine, it's trading at 548, maybe it trades down, maybe we just increase our range to 545 to 560 and simply say, okay, well, it's the more volatile, or it's trading in a larger range than we were expecting earlier this week. So far, it is not too exciting. It's sort of like earlier this week on Monday, our futures were actually up quite a bit, if I remember correctly, about 1%. So we didn't get too excited, and it actually traded down during that session. But again, what we identified on Monday was that this is the Monday bar, this green bar. So it traded up, so it looked like a huge gap up from the Friday close, and then it traded down, and then it traded back up. And then we said, oh, this is just in between the EMA 8 and EMA 20, and we're just going to chop sideways. So far, that still looks true. Even though we were gapping down to here, we're not going to get too excited about it, even if it trades down to 545, because down from 545, we are not too far from that MA50 and this 540 region. So yeah, maybe we get directional, but we're not saying, well, then actually everything we were looking for would be fulfilled at that point. It was that, hey, we were looking for maybe most likely a pullback down to the MA50, and we'd be fulfilled. Actually, that'd be okay, even if we have a neutral portfolio, because we don't want to go full bear unless we are expecting a large correction or a change of trend into a bear market, which we're still far away from. But MA200 is way down here. So maintaining a neutral position so far is looking like it's just fine. Now, if we are going to gap down and be really bearish, I want to see corroboration in the VIX. So let's take a look at VIX. And it is up. It's certainly up from yesterday, but not that much. You see this move? This move way down here. This was Monday. And then how much have we popped back up? Not even nearly as much as this. Maybe a quarter of this bar. So let's just put that into context. Monday, today. Monday, not that much movement. I guess we have to go close to close. Today is the same amount of movement. Why? Because we're from here, 548.69, which is basically exactly where we are, up to that EMA 8. And now we're saying, okay, well, we closed near the EMA 8 yesterday, right back down to that 548.69. But my VIX did not cover the same territory. It only covered about 1/3 or 1/4 of that. So VIX is not reacting, which means this is more likely a false move, or I shouldn't call it a false move. It's more likely just a chop sideways. It's not downward movement with conviction. Volatility is not spiking. Volatility didn't jump way back to 17, 18, 19, 20. So far, VIX is confirming our suspicion that this is not a huge movement. We're just probably going to chop sideways. The 550 area on the S&P 500, this is going to act as a strong magnet for the rest of the week. So we're not going to, most likely until Friday, we're not going to deviate too much from 550. We're not going to break down way below 540. We're not going to go up way above 560. We're not going to make a new high this week. And we're not going to crash below the MA50 this week. So if anything, we'll just go right back up to our thick lines right here that we drew on Monday and say, okay, well, we were saying 550, 560, and we widen out our range to 545, 560, or 540, 565. No matter what, that's not a change of trend. No matter if I go down to 545 or 540, that's not a change of this overall uptrend. If I go up to 565, that's not making a new high. So either way, this is just a large range chop movement. If we break 540 or we break 565, that's a different story. The chances of us doing that is very, very low. So, and in fact, I don't think that we'll hit 565, and then still don't think we'll hit 540, but there's a higher chance that we'll hit 540 than we will 565. We also have some major economic news coming out. That is tomorrow in the form of GDP, the jobless claims, and we also have personal income and outlays on Friday, which means that institutions, they are not going to put large-scale position in any direction before those news reports come out. That means if we move down to here or move down to here, it's not going to be on huge volume, and it's not going to be with a lot of conviction. So yesterday, we had a very small amount of volume as we thought we might get, total 35 million on a moving average of 46.7. So about 3/4 of the moving average. It's not that much. So what that tells me is that this movement, this big movement, is most likely mostly driven by algorithms. It's not big institutions throwing a bunch of money behind this. Unless I see huge volume today during the session and it's in a downward direction or upward direction, but more likely downward direction, then that might be a different story. But again, with these huge reports coming out later this week, institutions aren't going to just be throwing money around. Also, we had Google report last night, and the rest of the FANG stocks haven't yet. So before those big FANG stocks show their earnings, the again, institutions aren't going to want to put huge amount of capital to work. What if we start going down and we break down the MA50 and then institutions start shorting, and then Amazon has amazing earnings and Netflix has amazing earnings and uh, Facebook has amazing earnings. Apple has amazing earnings. What's going to happen then? Then all those institutions are going to be caught off sides because we're just pop right back up. So institutions aren't going to do that. They're not in the business of losing a whole bunch of money in a couple of days. So we're just going to most likely just chop sideways, and we're not going to expect today's downward movement to change our viewpoint, and we're not going to get too excited about this futures movement. What is happening is we are in a higher volatility environment than we've been in a very long time. If I look at this VIX, we were just for all of June, we just sat down here. And then even if we count this little bump up in May, which isn't as high as this spike over here, it has been since April, since the last time we've had seen these volatility levels. So for several months now, we've just been kind of doing this. And we've forgotten that the market can move 1 or 2% on a day, 3 or 4% on an extreme day. And pre-market, we can move 1.5%, and still be considered normal and not be a meaningful move. So yes, it's non-random. There is a directionality for the day and maybe for 2 or 3 days, but it's not necessarily a lasting trending move. So we're not going to get too directional. We're just going to stay neutral in our portfolios because of all of this. So now that we've gotten a good perspective on this move, then we're just, and if you look at it visually, you can say, oh, okay, we're just going back to where we were 2 days ago on Friday. Or I guess that's three sessions ago, because we're starting over here. 3 sessions ago on Friday. So it's really not that exciting. It's not a huge move. So hopefully we've got the good perspective on what this market is doing pre-open, and we can plan accordingly. Now, what kind of stocks? Remember, we said that, okay, it's mostly tech and mostly NASDAQ. And what are the type of stocks that are going to do well? So let's see. So we saw VIX. We talked about yesterday about closing that VIX at the open today, which is what we're going to do, and say, okay, we get a little bit of a boost because it did pop back up on our VIX hedge. And if we wanted to hedge anything, we wanted to hedge the tech stuff. So that's pretty germane. The big move today is in tech. So if we're going to hedge anything, it's going to be that tech. Let's take a look at the VXN. And even that, is this today? No, we don't have a pre-market move. So we don't know how VXN is reacting yet. So that hedge we can take off today, because we're really just expecting continued chop, except for maybe directionality on Friday. And then what type of stocks are we in? So publicly, we don't know this, but one of the orders that we placed in portfolios was Walmart. So let's take a look. Pre-market, Walmart is down 10 cents from yesterday's close. So we want to pick the right sector and strong stocks in the right sector. Basically, what we're saying is that Walmart is flat when the S&P 500 looks like it's going to open down 1%, and Walmart is super strong to the market. So what if we're correct and SPY just chops up? And so if we have a big down move, then we're just going to move right back up at some point. If we're chopping, right, we're not going to have a sustained move. If we're saying chop is okay, it goes down, it goes back up. What happens when the market goes back up? And Walmart did nothing when the market went down. Well, when the market goes back up, we can expect a nice little bump in Walmart. So those are the type of stocks that we want to look for. Walmart is a very, very great example of that. And I'll just show you some of these stocks on my watch list. So GoDaddy right here. You can see it's down. It's just opening down to this EMA 8. So relatively strong. Gold is up. Gold is up. So those are the type of stocks that we want to focus on in this environment. So we are getting a lot of volatility in the NASDAQ stocks, which means if I catch this down wave, then I lost a bunch of money, but then I'll recover it when we pop back up. And then that might be a little bit of an emotional roller coaster. You might like that because there's a lot of opportunity in a day trading environment. If I see this pop way back down here and I see momentum shifting to the upside, I can make a large move in during the day and make a lot of money. But a lot of people can't stomach that, and it gets to be too stressful to watch the value go up and down and up and down. And so if you want to see something much more reliable and more steady, then you look for these strong relative strength stocks. And what we've seen is that in the Dow Jones, for example, yeah, we're down, but what does that look like compared to QQQ pre-market, QQQ pre-market down to the MA50 from up here? Okay, it looks like a down to the lows of Friday, and then Dow Jones. Okay, just baby move down, also down to the lows of Friday, but that's not nearly as much. And so what we're seeing is that the Dow Jones right now is a lot less volatile than a QQQ, and this might be easier to stomach. And so we go into blue chip type stocks like Walmart. So hopefully that gave you a very good perspective. I only had one thing I really wanted to focus on this morning, is just that's getting the right perspective. It's easy to get emotional. It's easy to look at something like this and go, "Oh my gosh, the world is falling apart." It's not easy to take a calm look at everything and just say, "Hey, before I get emotional and before I react and have knee-jerk reactions with my trading, let me just get perspective and make sure that I'm comfortable with everything that my emotions might be telling me to do. Like, oh my gosh, panic, sell, close positions, or sell short, or whatever it is." Well, so now we can say, hey, now that okay, what if I'm wrong? Okay, so that's sometimes that's something that we always want to think about as well. What if I'm wrong and this we don't chop between 545 and 560? Okay, well, my next move is down to 540. And how much does that hurt my portfolio if we go down to 540? If I don't act here, I have another chance to act at the MA50, which isn't quite 540. Does that kill my portfolio? If it does, that means I was super long in my portfolio, not neutral. If I was neutral, then yeah, I might suffer some losses, but not a huge amount. And if that 550 holds, or sorry, MA50 holds, then we'll be fine because we'll recover. And then if it doesn't hold and I still didn't take action, or below that MA50, then I might be in trouble in my portfolio. But I have at least two more chances to act before I'm really hurt by my portfolio. So what if I'm wrong? It's just not that bad. It doesn't even mean that I need to take some sort of corrective action. So for me to sit here and say, okay, we're just going to chop sideways, let me just take no action, then it doesn't hurt me that bad if I'm wrong. What if we break up to the upside and go above 560? Well, I still have a chance to react on 565, and I can buy a breakout. So again, the perspective that I have right now is not only what I based on my analysis, the high probability event. It doesn't hurt me to keep this perspective in the event that something else happens. And that's the way that we always want to look at things. Because what if I have high conviction that we're going to chop sideways, but then we break down. What if we were chopping sideways right above the MA50 and we break way down? Then my portfolio would suffer a big loss because there's no support. There's some support right here, but that's a pretty big movement. And then there's some support. Then the next support is that MA200. So if I don't take any action at that point and say, okay, well, I'm going to be right, then it hurts me a lot when I'm wrong. So if that were the case, then I needed to take some action. Oh, we're going to chop sideways. That's the high probability event. But if I'm wrong, I'm going to get hurt quite a bit. So what do I need to do? I need to hedge. But in the case that we are right now, if I'm wrong, I'm backstopped twice to the downside. I'm backstopped at least once to the upside. I have time to react and change my portfolio before I get hurt, or at least before I get hurt too badly. So it doesn't hurt me to just say, okay, we'll just wait and see if I'm right about chopping sideways. So that's how we want to think about things. If I'm wrong, how badly do I get hurt? If it's too much, then I need to take an action like hedging. If it's not that much, then do nothing. Why spend money on a hedge if I'm really, I might lose more money hedging myself than I would if I just sat there and did nothing. So in that case, we just wouldn't hedge. We just let our portfolio be. Okay. All right, guys. Hope you guys are learning a lot. We got 9 or so minutes to the market open. So we'll end it here, let you guys prepare for market open, and I will see you in the post-market analysis.